You know, it's no secret now that the real estate frenzy of the last few years is over. And does that mean, though, that a crash is coming? Is it suddenly a bad time to buy a house? It's kind of ironic because, maybe this market where we have some more supply, we have fewer bidding wars, maybe it's like actually getting close to finally being a good time to buy a house. Like we have less competition, there's fewer bidding wars, we have more selection for buyers. And, and aren't those exactly the conditions we've been desperately looking for over the past few years? So maybe we should be celebrating the new housing market conditions. But of course, buyers and sellers need to know not just what's happening right now, but they have expectations for the future. So we as professionals can see and help them see into the future. What does next year look like? And that's what we can focus on today. We'll focus on what the fall looks like and what next year looks like. And then we'll dive into all the details and we'll have our current view as best we can. So Altos Research tracks every home for sale in the country, all the supply and demand, and every week we bubble up all those analytics so that you can see them before you see it in the traditional channels. The headlines are going crazy right now with the shift in the market, but there's a lot of power. There's a lot of interesting demand happening. There's different shifts happening in different local markets. So I'm Mike Simonsen. I'm the CEO of Altos Research, and let's dive into what we're looking for at this webinar today, middle of July, 2022. The things we're going to cover today. So, inventory is climbing. How much inventory are we going to get? Where is it going to stop? Where is it going to grow? We have latest versions of our forecast of inventory for the year, and we can start looking to see where next year may present itself. We can look at each week through the rest of this year. What to expect with home prices? So we can see home prices are still at record highs. And so we're going to look at some of the leading indicators to see whether we can see changes in home prices in the future and next year. We'll look at all the other leading indicators in the data. We're going to, as we like to do in these conversations, help frame the conversation so that buyers and sellers know what's happening right now, help them work through their fears, help them make good decisions right now with the data. And we'll take at the end some time to look at the local markets and do our deep dive there. And meanwhile, we'll have the chat to ask and answer questions along the way. Look for Lael and Jeff from the Altos team. If I share links and things, they'll drop them in the chat so that you can answer that. You can grab those while we're talking. The first thing that's been on everybody's mind this year is the change in mortgage rates. The interest rates have climbed from their record low under 3 to well over 5, over 6 a couple of weeks ago. And so we'd like to start the conversation with this chart. These are mortgage rates over the last decade. And each color here is a year. And you can see the last 3 years, how low they were below that long-term average. And then the brown spike at the far right end of the chart here is this year. And obviously that spike in mortgage rates put the brakes on the frenzy. Buyers recognized it. They changed their behavior very quickly. Investors changed their behavior very quickly. And then the last few weeks, we've actually had downtick in rates. So as of right now, rates are not continuing to spike. They maybe have reached a new normal. And what that tells us is that the affordability changes that hit really dramatically from the 6 months ago, the beginning of the year to now, those affordability changes they're not getting less affordable. Like we've sort of hit a stable state. Now, and so that implies some interesting things for buyers. Like, do I need to rush? Do I expect as a buyer rates to increase or decrease from here? because if I expect them to decrease from here, I can refinance in the future. If I expect them to increase, it's a good time now to lock in. Those are the kind of perception that we can use with the change right now. And the change right now is, it's like, have we achieved a sort of a new stable point for mortgage rates? Have we gone through that shift? Now, I am not a forecaster of mortgage rates. I don't have any particular insight of what happens. I do, however, talk to some really smart people about what might happen with mortgage rates and the rest of the housing market. The Altos, if you haven't listened yet or watched the videos, we have the Altos Research Top of Mind podcast. We talk about the data here with Altos every week, and we talk about the real specifics, but there's a lot of other really interesting people who know a lot about the housing market, and I get to interview them on the Top of Mind podcast. This week, I interviewed Len Kiefer from Freddie Mac, and he is a person who forecasts mortgage rates. And so the next week, the Top of Mind forecast will feature Len, and we talk about things like, how do you look at the future of mortgage rates? So a couple of recent ones, really for the listeners here, there's two types of interviews that I tend to be doing on Top of Mind. One is with housing market analysts, people who are really smart about the data and see a lot of data, and sometimes different data than I do and that we do at Altos Research. So for example, Logan Mohtashami, a couple of weeks ago, and we talked about his model for the future and all of the different macro variables that he uses. So Logan is an analyst that we interviewed, but we also interview really smart people for real estate professionals. Jimmy Mackin is the CEO of Curator, and Curator is a real estate marketing firm, and he is so good about how to talk to buyers and sellers right now. And Jimmy talks in that webinar about, it's really the questions that we're asking right now to help frame the conversation. So it's both the data and the conversation, which is what we try to cover here, but this is how I get to be with many more smart people. So that's the Top of Mind podcast. It is, we do one every week, or not on our webinar week. So 3 a month, and they're just really terrific conversations. So I hope you go and check that out wherever you get your podcasts or on the Altos YouTube channel. Okay, let's dive into some data. So total inventory of available single family homes unsold rose to 491,000 this week. It rose 3.25% over the holiday week. The July 4th holiday week is last week. That's a pretty big rise for the holiday. You can see each year here, there's the bump for each year, and we're approaching late summer is when we get to our peak inventory most years. And there's often a dip during the 4th of July holiday. This year, we're still on the upslope. We haven't turned the corner yet. And so we still have a fair amount of inventory to build for the year. And it'll be really interesting. Normally by late July, we've turned the corner, and that upslope steep has started to curve. It has not started climbing. It's not curved yet. So you can see the far right side of the chart here. The slope is still up. That is more supply coming to the market. It's pretty much across the country. It is in the hottest, the markets that have been the hottest all year are in the last 2 years, the places like Austin and Boise and Salt Lake City, some of the Florida markets. Those are the ones that are gaining inventory most quickly right now. Much of the migration push has slowed down. The people leaving California and going to Phoenix, those has slowed down significantly, and therefore sellers in those areas are the ones who are most surprised by the abrupt turn, and inventory is building most quickly there. You can see here that inventory at 491,000 is still basically half of what it was even in 2019. So even 3 years ago, the current available inventory is still basically half of what it is normal. And if you look back, 6 or 7 years ago, it's significantly fewer still. So we are not even yet back to normal levels of available inventory. And that's really telling. Rising quickly, trying to normalize, but we can see that it's got a long way to go, and there's really no no wave of sellers that have to sell. There's no pressure selling because everybody who already owns has their mortgage locked in super cheap. There's nobody. Everybody has equity. There's no short sales because there's nobody in the country who's short on their mortgage. Essentially nobody. There are a few people who are at risk who bought right at the peak in the boom towns. And then if they, for example, if we roll into a big recession next year, a big job loss recession, some of those people would be at risk. But in general, it's as very few people. The country is so secure in their existing homes right now that it's unlikely to see any big wave. So then the question is, where do we get to? What's normal from now? And I'll show you a few examples of how we can project what'll happen for the rest of the year, and what's happening in the inventory process. This is a view of new listings per week. So the homes that come out and get listed, and then they're unsold. So you've heard me talk about our immediate sales, and the immediate sales are those that they get listed and they go into contract essentially immediately, hours or a couple of days after listing. And you can see here the dark red and the light red line the last couple of years. See how they were lower than every other time, and that's because there were so many immediate sales that they're not on the market. They're essentially bypassing the active market altogether. But watch this dark red line here. It starts to climb, and the last few weeks we've had more listings unsold staying on the market than we have in any of the 6 previous years in early July. So a couple things you notice. You can see each year there's a July 4th dip of new listings, and this week there wasn't that much of a dip. So there was still a lot of people. Some of that is these are sellers who were thinking of selling sometime this year. The supply is being pulled forward because sellers are worried about conditions deteriorating further from here. So if you were thinking about selling sometime this summer, a lot of those folks are rushing to list right now. And so you can see that in the new listings each week. The other thing to notice here, though, is this is not like skyrocketing. This is not, the 120,000, 30% more than normal. This is a few thousand homes more than normal, and more than, not even normal, more than the last few years. It's a little bit more. It's noticeable. We can see that steep upslope in the total inventory curve, but it's not like shooting through the roof. And I think that's really telling. And we'll see in the next few weeks if it starts to tick down. You can see each year now, the later half of the year, the new listings start to decline a little bit. We start to get closer to school time, and you don't want to have your house on when you're trying to start school. Then we roll later in the year. Now it's the holidays, and so the market starts to slow down after the first week of July. And so, so next week will be really telling. Does it go up from here? And that would be a sort of, a sign that more sellers, more people are getting worried, fewer buyers on the immediate sales. All of those signals could be happening. Or if next week we start to tick down a little bit more like this natural curve, that would project that we're settling into a new normal level of inventory. So next week, we'll keep our eye on this in the weekly video. This is another way to look at that inventory. So each bar here is a week of the inventory change. Above that line is inventory grows for the week, and below the line is a week when inventory shrank. And so you can see that each color is a year, and the light blue in the middle there that's 2020. So right at the end of March, people started buying everything, and inventory shrank all year long, all the way through very late into 2021 before we started to get a little bit of summer inventory. And now the dark blue is this year. And so we had our biggest inventory gain was 2 weeks ago, 31,000 new homes came, inventory built. So that's new inventory and fewer sales. And that's the biggest week we'd had in a bunch of years. Like that's a significant inventory increase. It's across the country and especially in those hottest markets. The brown are the weeks as we forecast each year going, or each week going forward for the rest of the year. And so I expect next week we'll have a pretty big week, maybe 27,000 more. That's that little spike in the brown, and then each week down, declining into August, and then at the holidays we start declining to reset for the following year. And so this is based on the strong seasonality of real estate. Fewer people sell their homes over the holidays. And so the next big holiday will be Labor Day, and Labor Day being in September. And so there'll be fewer of those. And that's also like the start of school. And then we'll have a little bit of stabilization in September, October. And then you start to get to the November, December holidays, and then inventory drops really quickly. So that's what we're looking at for the rest of the year. And assuming it follows those patterns based on where we are now, this is the forecast for where we will end the year with active single-family homes unsold on the market. Looks like about 450,000. That's the dotted line here. And you can see how the curve is going to continue to grow through July, August, and September, and even into October. Beginning of October is probably the peak, and then start to decline a little bit for the year. And so dramatically bigger than the year before, not quite double, but almost double, which is a significantly more than where we ended 2021. But also significantly fewer than most recent years. So even fewer than we started 2020, pre-pandemic. And so what that tells us is that next year, because supply will be reasonably tight, we'll have a market that resets into a sort of a normal space. I use as a rule of thumb year-over-year inventory gains. Right now we have 31% more homes on the market. This is where the solid dark red line ends. 31% more homes on the market than we did last year at this time. And that year-over-year gain in inventory, more supply, less demand, that tells us where prices will be about a year in the future out. So next year, it really looks like we are probably at a 0%, essentially zero home price gain in 2023 over 2022. Most of the price gains are baked in the first quarter and early second quarter. So this year, we had that super strong upslope, and we could already see that 2022 would be a 10 to 12% home price gain for the year, and that's really what it's looking like. So, but next year's looking at like about zero, about flat. So that has implications for investors, especially fix and flip investors. We're looking at essentially no home price gain. There isn't any signal yet in the data that I see that would imply home price falling next year. But there are some places that will keep our eyes open if, for example, inflation gets worse or recession hits or some of these other big macro changes, which are, are not in the data yet. But if big recession hits, like that would adjust the forecast, it adjusts the where prices may go. But in the data right now, that's what it looks like. Expect essentially no home price gain next year. Let me go here and let's do a quick view of local inventory. So this is the Altos Advanced Analytics platform. This is in beta. A few of our customers are in beta right now. So what I have in the platform right now is I have all 50 states ranked by inventory. And I look at this all the time each week because I am watching this upslope. How steep is the upslope in each state? So for example, in Texas right now, 52,000 single family homes, and you can see the little slope is ticking up each week, pretty dramatically, but still only half of the homes that were on the market even in 2019. So we're going to expect this guy to keep climbing nicely for the rest of the year, but not get close to the old normal. California has been climbing quickly, but is about 2/3 of where it normally is. So California is going to keep that, but is not actually climbing. Texas and Florida are climbing more steeply on a percentage basis. They're trying to get back to normal much more quickly. All the hot markets. Here's Arizona. Look at the steepness on this curve here in the last few months in Arizona from beginning of April. And so Arizona is climbing much faster than the country as a whole. And you can really see how it stands out there in this comparison, how much more steep it is. North Carolina with the East Coast migration states, North and South Carolina there. Here's Washington. So this is Washington, a big destination for like California migration. You can see how that inventory is building very quickly. Washington has been among, Seattle's been among the hottest. Here's Colorado. So like all of the places that have been the hottest markets around the country, you can see inventory building most quickly. Look how steep Nevada is. And Nevada at 8,000, 3 years ago was at 11,000. So Nevada's going to get pretty close to normal. But even a few years before that, in available single family homes in Nevada, mostly Vegas, was easily 15,000. Bubble burst, it's like 25,000. Like it's significantly fewer than it was, but rising very, very quickly. Here's Utah. So Salt Lake City has been among the biggest migration destinations here. And here's Idaho. Idaho may be the steepest here. You can see from 1,800 homes to almost 7,000 this week. That's a big change. Idaho is about where it was 3 years ago. So Idaho is really one of the few places where we've maybe gotten back to normal levels of inventory. And you can just see across the country. The ones that have lower upticks here are places like Connecticut. So these are a lot of the Northeast markets or Midwest markets that aren't significantly, there's not significant inbound migration, much slower to change markets. So you can see the slope on Connecticut is significantly lower and still way below where it might be normally. So that's a quick look, and we're going to dive in later into the presentation to look at some of the local markets. It's some of the more details there. Okay, let's talk pricing. The median price of single-family home in the U.S. right now is $450,000. That ticked down a little bit from last week. It's totally normal to tick down this time of year. You can see each year has a summer plateau. It really hits that plateau typically in the dark red line, the beginning of June, and it typically turns sideways, flat, and then starts to tick back in the fall as the best inventory gets consumed. And as you list in the fall, you do so with a little bit of a discount so that you can make sure it moves. So that's the curve here. The leading indicator. So this is the red line, the dark red line here is a leading indicator of transactions that will complete in the future. Houses are on the market now. They get an offer in August that closes in September or October. And then that data starts to hit the headlines in November and December and January. And you can really see it now. So the headlines, the traditional headlines, the Case-Shiller index and some of those indicators are still going to be very, very positive through the whole year, even as the inventory has climbed as we've been showing. Now, the light red line here is the new listings each week. And that's a leading indicator because this is where if you go to sell your house during the 4th of July holiday week, you are very sensitive to how many people are down the street at the open house, how many offers, did they get multiple offers, or are there any offers at all? And what you choose to do is if those multiple offers are maybe drying up, you you list a little bit lower to make sure that you don't get stuck on the market. You're looking to create your offers. And so in collection, then if everybody's doing that, then the light red line ticks down. The light red line did tick down this week to 405,000 from 420 last week. It's a pretty big move. 4th of July is not uncommon to have that move. Last year, you could see there was a downtick from like 369 to 350. So that it's not uncommon for that to happen during the holiday week. What we want to keep our eye on is, does that keep going further? Does it keep adjusting further? And it's going to adjust down like most years in the second half of the year. The price of the new listings gets cheaper because people discount a little bit as we're later in the year. It hasn't yet adjusted dramatically. And that's an indication that, the right homes are selling, the right homes priced properly are selling, and some of them are still selling very quickly. And so that indicates that even though there's inventory building up in like a lot of those the states that I mentioned, it's not a lot. There's still, there's still buyers who've been planning to buy for 2 years and finally getting their opportunity. Those kind of things are happening, and that's keeping our prices at essentially almost record high levels. And we've probably, last week was 455,000. Probably the last time we've seen that number, maybe for 2 years. It'll be really interesting to see if next summer we cross over and prices move higher than 455, but it might be 2 years before we break that record high again. Something to keep your eye on. On the other side of pricing are the demand indicators. And if you've watched this or any of the videos, you know that we like to track the percentage of homes on the market that have taken price reductions. The price reductions right now, the dark red line, each line here is a year. And you can see that the market turned very abruptly starting in March. And price reductions this week, 31.7% of the homes, single family homes on the market in the US have taken a price cut. And that's a totally normal range. But you can see the slope of that curve, the dark red curve, is climbing faster than normal. So that's implying going from record hot, slowing down rapidly to normal. I expect to see us climb over in August to 40% of the homes on the market. If we got to 45 or something like that, would be pretty bearish for prices during that in the next year. But I think we're going to see our curve start. It's going to be the highest, most price reductions we've seen in many years. By the end of third and fourth quarter. But my suspicion is that we're going to get our seasonal curve here and then adjust back down for the holidays, which would set us up for a flat year over year 2023. More supply, demand muted a little bit, but and so therefore, no price appreciation next year. And so that's where we can start to see it in the data right now. If price reductions continue to skyrocket well into September, that's going to be a leading indicator for the following year. So keep your eyes on that price reductions number. Normally, 30% of the market, about a third, 30, 33%, 35%, take a price cut before they sell. And sometimes that is strategic, intentional. We're going to overprice and then we're going to see what happens. And then we're going to take our best bidder. Sometimes it's accidental and like it's a seller who wants to try the market and see, and then they don't get offers and now they have to take a price cut. But about a third. In some local markets like Arizona, Phoenix, for example, 40% is much more common than a third. But and that's like related to having a lot of a lot of flips, a lot of things like that. A lot more inventory per capita than, say, the California market. So we'll look at the local levels and the normal levels there. But across the country, about a third is normal. And, we're right there about normal right now. It just feels wild because it's been so hot. that normal feels cold. Here's another leading indicator for demand that is going to be very important to watch for the rest of the summer and as we go into next year. And it's been sort of in a normal range lately, so it hasn't been very interesting until right now. And this is the percent of homes on the market that have been relisted. Either they went into contract and the contract fell through, and there were no backup offers. So now the house is back on the market. Or there's no bidders at all, and now it sits on the market for a couple of months, and now it looks stale. So sellers pull it off the market. Maybe they throw a coat of paint on it and then put it back on. And so these relists are a real sign of the organic levels of demand out there. You can see each year is we're in this little band. There's always some that fall through 1 or 2%. It spikes at the beginning of the year because stuff gets pulled over the holidays and then relisted. The last few years didn't spike over the holidays. You could see the dark red line didn't spike this January because we didn't have to pull things over the holidays. Things were being sold. But what we're seeing right now is each of the last 4 weeks has been trending higher and higher than previous years. So right now, 1.7% of the active market was on the market, off the market, and is now back on. Like went into contract and is now back on. And we saw an uptick this week. It's not a frightening amount, just like our new listings. It's more than it has been. And it is signs of the market rapidly normalizing. If this relist climbs, that implies contracts falling through. It implies no backup offers. It implies financing that is getting more suspect, tougher underwriting, or appraisals not making. And in the last few years, if you missed your appraisal, people were compensating for that with more cash. And they may choose not to do that right now. So the relist is a leading indicator of demand. So we can see it's decreasing. And then the question is, does it get higher? Does it go higher from here? Does it go significantly higher? When the bubble, for a reference point, when the bubble burst in 2006, and we just started Altos Research in Silicon Valley, and we could watch homes in Silicon Valley. At that time, if the house was on the market for more than 30 days, it was stale and people didn't want to buy it. They thought something was wrong with it. So sellers and listing agents would pull the house off the market and then relist it as a new listing. Maybe they'd keep it off for 31 days and then relist it. At that time, we watched relisting climb to 30% of the market in some parts of Silicon Valley. And that was an abrupt change, right? We're at 1.7% nationally right now. Some local markets are higher, and that depends on a lot of local factors. But at that moment in Silicon Valley, the relist climbed a third of the homes had been pulled and relisted. So that was a real strong leading indicator. And that was 2006. That was a real strong indicator of what was going to come in 2007 and 2008. So keep your eye on the relist rate as we go forward. We've been talking about on the demand side, the immediate sales indicator. This week, 23,000 homes still went into contract essentially immediately after listing. What we can see is the biggest thing here is that's growing fewer percentage each week, and it's staying actually higher, more than I expected. Like there are parts of the country and homes that are good properties and priced well that are still going into contract very quickly. The most notable thing on this chart, though, is how the holiday week didn't take a week off. Last year, you can see there's a dip in new listing inventory and fewer sales. And then this year, though, they're like, we're going to list them now. And like I said before, that looks to me like inventory supply being pulled forward from later in the year. People worrying that they need to rush to market now and not wanting to miss even a week. So we're going to keep watching this as the light portion of the bar shrinks each week. Those are the immediate sales, and the dark portion is each week's new listings that stay on the market. And so we're going to watch that shrink towards the end of the year. As this stays at least a little bit stronger, that's a bullish sign for me. And one of the signals that I'm looking at that says, yes, inventory is climbing, but it's actually like there's no sign of catastrophe happening anywhere out there. Those are the immediate sales. And here's the percentage chart. So what we could see was at the far right side of this chart, the percentage, was super high. A third of the homes were going into contract immediately earlier in the year. And now that's dropped way down, and we'll watch that continue to get down, probably closer to 10% by the end of the year. And you can see that normal line, or the line of the last couple of years, that average, and how quickly we've fallen below that. So currently about 20%, though, still going into contract very quickly after selling. Those are the ones that are priced right, the good homes, and so that's like a real powerful message for buyers and sellers. It's like, is this market completely tanking? Well, if you're priced right, you've still got buyers who've been trying to buy for 2 years, so we can make this happen. All right, and then one more thing on the supply and demand. We'll switch gears, and then we're going to do some local stuff. This is the pending contract versus the active inventory. The notable thing in the last couple of weeks is that the active inventory has finally climbed back above the number of homes that are in contract. It's been really wild for the last 2 years of pandemic frenzy market. There's actually been, at any given time, more homes under contract than were on the market. Like the inventory was so tight that there were more that were sitting there pending, and then you could actually buy. That showed up if you ever compare the Altos Research inventory numbers to things like the NAR's inventory numbers, because NAR will report last month and they'll report pendings in the active inventory, and so their number will be a lot bigger than the Altos number because they include pendings in it. But what we've noticed is in the last few weeks, the number of pendings is finally falling off, and the active inventory is climbing. This is a much more normal scenario. Normally, there'd be maybe 3 or 4 times more active than pending. So we're finally getting back to normal. But that transition point's finally come, and it's been a couple of years since that case. When we look at, if you've been watching investors, and you may have a question about, do investors get cold feet and want to sell when as mortgage rates climb, as demand is obviously cooling? One way to keep track of that is obviously via rents. So rents have elevated, gotten really high, dramatic change over the last year. And as of right now, there's no sign of rents ticking down. So single family homes, median rent around the country is $2,300. And that implies that if I own my house, if I own a rental property and I have it financed at 30 years with a cheap mortgage, I'm making record levels of revenue on it. And there's no sign yet of that subsiding. That also, by the way, implies, because these rents are higher and ticking high, when you look at inflation numbers, like the inflation headlines, like we had the CPI yesterday at 9.1%, that's really the housing portions of that CPI are really data from 6 months ago. And so as rents were rising dramatically through the year and home prices, that's now shows up in the CPI numbers. And what it tells us is that the future 6 months CPI numbers like the housing components are still going to be contributing to elevated inflation numbers in 6 months because we can see it in the data right now. So it's just a little interesting tidbit. I was discussing that with Len Kiefer in the Top of Mind podcast that'll come out next week. So you can if you're curious about how rents and home prices work into the inflation numbers, Len gives us a nice little conversation there. Let's talk there. This is the percentage of homes with price increases. So we looked at price decreases, and what price increases tells us is this is really an indication of things like investor flips. So a house is on the market, it got bought, it goes into contract. Now it comes back on the market with a higher price in like a shorter period of time, like 120 days. And the dark red line here shows us that what's happened is in the last few months, we've gone to actually the fewest level of price increases in many years. The fewest, probably the least opportunity for quick fix and flips that we've had in a long time. And really what that tells us, like the investors know in aggregate that next year does not look like a good time to be flipping properties. And therefore they're not doing that move right now. And this is an indicator of demand. It's you can see earlier in the year and last year, we had these record levels and super unhealthy, lots of speculation where the dark red line and the light red line in the last couple of years were so high. We definitely don't want that in the market. Those are the types of things that led to the bust. Now those are gone very rapidly. And so like that's much more healthy space to be right now. It just points out that there are investor buyers in particular that are they're not like leaning into demand, like they're going to let that. That's why we can see supply increasing. There's fewer of those buyers to try to do things like flip homes. And you can see the slope of that guy has started to turn the corner. So it's not falling through the floor. That's encouraging. Like there's always some of that happening. And so, that like we will be in a decent space with price increases in the next year. And then finally, demand days on market time is ticking up, still less than a month across the country, but we can see it ticking up this week. It normally happens in July. The peak demand time and the fastest market time is in the second quarter. So like this is all very normal. Normally though, 2 months might be much more normal for July market time, but we're really under 1 month right now. And then it'll increase through market time will increase to the end of the year. Hopefully we get back to maybe where we were in 2019, because that would imply more opportunity for buyers, less competition, more opportunity for first-time home buyers, all of those things. But that's going to feel really, really slow to sellers who are thinking who are not dialed into this shift yet. And so as you're informing your sellers, you'll want to point out a bunch of these indicators, the price reductions number, the days on market number ticking up, the market action index, which we'll show you in a second, to help them know they got to price it right now so that things will move. We like to look at all the Altos data in price range segments, 4 price range quartiles. The high end of the market may be behaving very differently from the low end. And a couple of things you can see right here, the middle of the market, 21 days, you can see exactly where people are buying. Days on market's the right-hand column over here. But you can see over $1 million. The days is starting to climb. It's starting to climb pretty quickly. And the stuff at the very low end is typically poor quality, older. Those also ticking up in market time. So you can see where the market is slowing most quickly. That over $1 million, those are like the super high end homes in places like Austin and Seattle that had been moving super quick are now slowing down. By the way, I cover a lot of data and a lot of how we talk about the data. If you're new to Altos, make sure you read our ebook, How to Use Market Data in Your Business. So this is where we talk about a lot of the things I've been talking about, the price range segments, how to frame price reductions, what that means for buyers and sellers, scripts to use. There's a link in the chat to download the ebook. It's free, and it helps you look at the data that we're looking at right now. So in particular, things like the price range segments are really powerful when you're talking with clients. This is your price range. Use the ebook to learn how to have that conversation. Let's do market action index, and then we're going to go do a couple of local markets real quick. The market action index for the US is at 58 right now. That is still a seller's market. And we know that because inventory is still half of what it would normally be. So if you want to sell, that is those realities of right now. We also can see the difference between the gray and the red. That's last month versus this right now, and it's definitely ticking down. So one of the scripts to learn when you work with clients with your Altos reports is you say, while we have your house listed, I'm going to put this report in your inbox every Monday, and I want you to look at this one number. I want you to keep your eye on this market action index. If this thing is falling while we have your house listed, that's the market giving us a signal that things are cooling even further from here. And therefore, that might be the market telling us that we want to make sure our price is right to get ahead of the curve. So market is ticking down. It will continue to tick down. And I'm going to show you another. So this is the speedometer you'll see on every Altos report, and we'll look at a few local. In the Altos data, there's a 90-day rolling average, which is the dark line here, and the light red line is the weekly measure, and that can have some noise and it can bounce around a little bit. So that speedometer is showing that the dark red line, the smooth trend. But what we can see in the light red, each of the weekly readings is dropping very quickly, and so the weekly data is actually showing us that next month that the speedometer is going to be lower next month on the market action index nationally. And you can already see it there. You could see it at the beginning of this year where January is that low point and January 1 is a low point, and then big spike up. And that told us exactly what was coming for prices the rest of the first and second quarter. You could see it in that beginning of the year. You could see it in 2021 as well, big spike up. And you can see in 2020, there was a dip for the beginning of the pandemic and then big spike up again. So all of those indicators really help buyers and sellers know what's coming in the future months. Okay, let's switch to local markets, and then we will wrap up. So we've been talking, I've mentioned Austin a few times today. Austin was one of the hottest markets the last few years. You can see in the market action index in Austin, it's actually still a seller's market because we don't have as many homes as we normally do. Contracts are still going through. We can see realists are climbing to 4% in Austin. And you can see a pretty big move month to month in that market action index here. So that is a real shift that buyers and sellers both see in Austin. And so sellers who are listing now will obviously want to keep their eye on the market action index while they have their house listed. Because here I have the price reductions in Austin pulled up, and we can see this weekly line. So Austin is normally in the 40% range, 45% range. And a year ago, only 6% of homes had to take a price cut. So 40% are overpriced, thinking they're overpriced, but only 6% had to take a price cut. That was remarkable. This year was a little not quite as frenzied. It already started to shift by March in Austin, and then bam. And so really dramatic climb. And so we're going to see Austin climb up here over 50%. And these are the homes that were overpriced. They were going to try to get what they could get, and they didn't get their offers. And there are fewer people moving in from California, and those homes are going to have to take their price cuts. So those sellers, if you're listing now, you should know exactly what you're looking for. there, what you're looking at there. We can see that the expensive stuff in Austin is also the days in market is starting to climb there. Let's look at Orlando. Orlando, the Florida markets, the affordable Florida markets have grown significantly less affordable during the pandemic. And so we can now see the shift here. And this is the market action index. See the big move from last month to this month on the market action index in Orlando. Prices are still at their record high, but look at the market action index. And so next month is going to be significantly lower. We're going to get back down here into much more 30 is the balanced area. And it looks like we'll get back to a much more balanced market in Orlando very soon. And so we can watch that. And we can look at the price decreases in Orlando climbing from 18 a few months ago up to 38. Like that's climbing very quickly. Take a look at Charlotte. Charlotte's another one that is big inbound migration. Charlotte has a lot of New York migration. And so we can watch. Charlotte's also one that has typically a 40 to 50% price reductions. And this spring we were at 16. Price reductions are climbing very rapidly, 40% now, and maybe turning the corner here, settling in. So we can see in Charlotte, let's look at inventory. We can see that inventory is climbing, but still half of where it normally is this time of year. And that's even in 2019 was pretty low already. So still lots of room to grow there. You can see in Charlotte under 500,000 still has a lot of demand. You can, exactly where the people are buying. I'm going to do Nashville and then we will wrap up. Nashville and inventory is climbing, but, from just a couple of hundred homes, where normally we might have 1,500 homes, we had a couple of hundred earlier in the year. We're now up to 600 or 700 in Nashville right now. So significantly more, but still not many. And so while we can see in Nashville that, like just everywhere, the market action index is ticking down month to month, and week to week, it's not ticking down nearly as dramatically as, for example, Austin or Orlando is. It's a much more stable market. And the further north and east you go, you have the markets are more stable and slower, and therefore are not adjusting nearly as rapidly as a lot of the South and West markets are. All right. So that's all the data we have time for today. If you need to have this conversation with your clients, if you have buyers and sellers who are trying to figure out what's happening right now, make sure you go to altosresearch.com and book the free consult with our team. Click the getting started right now. You can get the data to your customers today so that they know how to make that decision, that they can see as the market continues to shift, they can be in front of that. They can help make more informed decisions about whether they want to bring their supply to list now because they're afraid the market's going to get worse in the fall. Or if there's more opportunity in the buyer's side, do they need to make an offer super quickly? Do they need to overbid? All of these questions we can start to see in the data, and they need to hear it. They see it from you and see it from you every week because it's changing so rapidly. So go to altosresearch.com and book that for the team. All right, back to the video, more data next week, and we'll do another webinar next month. Thank you all for joining us. Appreciate you. The team will stick around in the chat and answer a few questions.